Thank you everyone for joining in today on Saturday. Thank you, Ms. Sandeep, for joining in and addressing our clients. I'll just start with your introduction for the benefit of our audience. Mr. Sandip Santdasani is an Associate Vice President Investments for PMS and AIF at ICICI Prudential AMC and has a rich experience and understanding of mutual fund portfolio management services and alternate investment funds. He has been associated with ICICI Pru AMC for more than a decade now. He is a CFA charter holder from the CFA Institute and holds a master degree of finance from MS University, Baroda. Sandeep joined ICICI Pru AMC in 2008, and since then he has successfully carried out various roles and responsibilities across product development and strategy in PMS and AIFs, both on long only and long short funds, as well as in mutual funds. He is currently a part of investment team in PMS and AIF, involved in equity research and developing quant-based models for stock selection. As a part of a core team in PMS and AIF, he provides key insights on products and investment processes to both internal and external stakeholders. Through his role, he maintains a dialogue with external stakeholders based on prevailing portfolio positioning and strategy across long only equity and long short funds. Thank you, Sandeep, for joining in. And thank you for choosing this very interesting topic. As we know that these are the three pillars for investments, and the markets are driven by emotions, economy, and earnings, which are the fundamentals. So we invite you to speak on this interesting topic and address our audience.
Thanks, Aditya, and thanks a lot everyone for joining on a Saturday morning and giving us this opportunity. We are very privileged to have this platform where we are addressing all of you. Broadly, if you see the topic which Aditya also highlighted, we are trying to cover in today's call is 3 E's of equity. Right? And for equity markets to do well, or for equity portfolio to do well, I would say these 3 E's are very important. First of all, the economy has to do well, and it has to create those opportunity for the companies. Companies have to demonstrate the earnings, and the most important thing for us to make a return out of the equity markets, the emotions which remain very volatile because of the daily flows coming in form of news inflows coming on a minute basis is very important to control, and that's where the role of advisor or the role of the investment investor becomes very, very important to get that return out of the equity markets at a portfolio level. So that is what we are trying to cover, the 3 E's of equity, which is emotions, earnings, and economics. So if we start from how the economy is placed today, and whenever we talk about equity markets, we talk about what is going to happen in next 3 year, 5 year, 7 year, 10 year of time frame. So everything is forward looking. But it is very important to understand or to look back also that what had happened in last 10 years, 20 years, and how we have progressed as a country in last 2 decades or so. And that's where this slide is very interesting, which is giving you a perspective that how India as a country has grown in last 2 decades. Like if you see till 2009, India was not there in top 10 economy, and we became 9th largest economy in 2010, and from there on we kept on scaling. We became 7th largest economy in 2015. We became 6th largest economy in 2020, and today we are 5th largest economy. And by various different agencies, it is projected that India can become 3rd largest economy in probably a few years down the line. So that is how India has progressed in last 2 decades or so. And interestingly, if you see, last 10 years also were very, very interesting. And between, let's say, 2013 and 2023, lot many events happen, and the side effect of that event was that between 2013-14 till end of 2020, if you see, the earning growth rate of markets was almost flat. At an index level, the earning growth rate was almost flat. And the events, all the steps which were taken were very, very positive, very, very structural in nature, and we believe it can position India very well for next 10 years or so. The initiatives like Aadhaar card based direct benefit transfer, which was started in 2000 also. Then you had initiatives like RERA, which came in 2016. A regulator for one of the largest sector, real estate, came in 2016. We were not having regulator since ages, but it came in 2016, and obviously it was coincided with demonetization, which has a very, very significant impact on the real estate sector. So the point is, in last few years, there were various important reforms which were implemented, like RERA was one of them. Then the banking sector went through a very, very tough time when RBI did asset quality review of the banking sector, and a lot of NPAs came out, and the net NPA number kept on rising in that phase. The point was we were able to recognize the problem, but it had to get resolved also, and that was the reason insolvency bankruptcy code also came, which was very, very useful, I would say, to resolve the NPA issue which were there in the banking sector. So again, that came in last few years. Then you had implementation of GST, simplifying the tax structure, which happened in 2017. A very important reform which many governments were trying since I would say almost more than a decade, but it got implemented in this last 10 years period. Then you had corporate tax cut and PLI kind of initiative also, which came in last few years, which was again very, very positive for I would say manufacturing sector, and for the overall economy also it was very positive. Then you had the budgets, which are more focused today, if you see, since last few years, on infrastructure spending. It is more focused on defense. It is more focused on railways. It is more focused on metros, which has a multiplier effect on the overall economy. All this is something which has happened in last few years, and that's where we are very well positioned from next 3 year, 5 year perspective. So that is how the direction of next 3 year, 5 year looks like. But interestingly, in this period, since 2000 till 2020 to last 2 year, the 20-year period, if we see, markets have also delivered returns. So this is a chart of index return and not any portfolio or any funds return. Someone who had invested into index, the BSE 200 index, 1 crore invested has become 19 crore. The CAGR return is around 14%. And we are not talking about any scheme. We are talking of the index itself. So obviously schemes or the actively managed portfolios would have done well than this. But at least at an index level also, we have seen this kind of growth. But when we see this chart, 1 becoming 19, it becomes very, very interesting, very, very exciting for any investor, that this journey looks very, very smooth. But the journey was not so smooth, right? These many events were there in between, and which led to very high volatility in equity markets, right? You can see we have highlighted all the drawdowns which were there in that period of more than 20%, more than 30%. The point is the markets have given this kind of return, but the journey was not very smooth. And that's where the role of emotion comes into picture, because we are connected economy. We are a part of global ecosystem, and that's where anything and everything which is happening inside, outside the country will have impact on the equity markets. So the point is you have to have time horizon on your side when you are investing into equity markets. And we believe there is difference between volatility and risk, and that is what we'll try to cover in the few slides coming. But the point is, if you see this fall, which looks very, very small in the long-term journey, but it was a lower circuit on that day when NDA government lost the election and market saw a sharp correction. The point is, in these many years, there were many falls which were more than 20-30% also. So today, I'm sure everybody is worried because of various reasons. We are worried because of global inflation. We are worried because of higher inflation environment. And we are worried because how the global economy will pan out in coming years. And that's the reason of worry today. But if you go back a year earlier in 2022, we were worried because of Russia-Ukraine crisis, which is yet to get resolved. But the point is, worries will keep on changing. If you go back 2 years back in 2021, we were worried because of second wave of COVID. 3 years back, we were worried because of COVID, and in these months, we had just started getting out of houses. The partial work from home was still there in this month of 2020. In 2019, we were worried because of another reason, right? We were worried because of elections, which was there in 2019, and there was global event which was there in terms of conflict between US and China, which led to higher inflationary pressure and disruption in supply chains. So the point is, if you go back year on year, you will find there were reasons to worry at all points in time. And that's the reason, as I said, equity markets will need patience. It will need time horizon, and that is what only equity market is asking from us. So that is what we want to highlight from that aspect. And you can see, while the chart was the first chart which we saw was very interesting, but these many falls were there, which were there in last 2 decades, which were more than 30% kind of fall. So more than 10 occasions were there where markets have corrected by this tune, right? So the point is, we will see drawdowns even in next 10 years when India moves from a fifth largest economy to third largest economy. We will see equity markets doing well, but in between we'll see these kind of phases also. So we should be ready for that, and we should actually take advantage of this volatility, and that's where the difference between risk and volatility is very important to understand. So one element is that if your stock price falls and never comes back, that is what is a risk, right? Which is a permanent loss of capital. Then there is volatility, which is a temporary loss of capital, right? Our aim should be to control the permanent loss of capital. Our aim should be to control the risk part of it. Volatility is actually the friend of investors, right? If we take advantage of that, if we put more money when markets are lower, we can deploy gradually also by doing STPs, booster STPs. A lot of many options are available so that we can take advantage of that volatility. The aim of investment team should be, or aim of any investor should be, to control risk of the portfolio. Where the stock price falls and never comes back, that is what we are trying to control. Can we control volatility in the portfolio? To an extent, the answer to that is no, but you can control some bit of it by keeping more diversified portfolio, by keeping 70, 80 companies in the portfolio, by keeping lot many mutual fund schemes in the portfolio. It will reduce your volatility, but we believe it reduce your returns also. The point is, the aim should be control risk part of it and not the volatility. And we believe risk to an extent can be controlled by putting a stringent filtration criteria of identifying companies when you are creating a portfolio. And that is what we are aiming for. And we'll try to highlight what we are trying to do when we identify any company, how we try to construct the portfolio, what all we look, and because of which the aim is to control the risk part of it. So that is what we are trying to focus on. And we believe volatility is something which will remain, and we can take advantage of that volatility. Now, whatever we discussed in last few minutes, it was more from economy point of view, more from a global and domestic point of view. But the core belief with which you operate on PMS and AIFs specifically is companies create wealth and not markets. And that's where the bottom-up approach is very, very important. And in that context, if you see this slide is very interesting. This slide is between 2009 and 2022, almost 14-year period data. And what we have done, we have tried to see how many companies were there each year which had delivered more than 15% CAGR over a 5-year period. So in this slide, how to see this is like, let's say 2009. If we take an example of 2009, this 5-year period between 2004 and 2009. Between 2004 and 2009, index has delivered 19% of return, but there were 239 companies in that 5-year period which had delivered more than 15% of return. So the point is, on an average, if you see, there were around 200 to 220 companies which have delivered more than a 15% CAGR return. Interesting is the year like 2012, where from peak to next 5 years, the index return is minus 2%. But even in that 5-year period, there were 77 companies which had delivered more than 15% CAGR return. So aim of any investment team should be to identify more and more from the top 2 rows, which were the wealth creators in that 5-year period. And aim should be to avoid the bottom 2 rows, where enough and more companies were there each year which had delivered negative 15% kind of return over a 5-year period also. So aim should be to avoid those, and aim should be to get more and more from the top 2 rows. That is what any investment team would be aiming for. But again, you will agree that this data is of outcome. this data is of return. You have to identify those companies beforehand, before that 5 year period completes. And that's the reason you have to have a very strong input parameter to identify these companies beforehand. And what we believe, the two very important parameter for any company or any portfolio to deliver return, the first one is the change in EPS. What kind of companies, what kind of profit these companies are going to deliver over a next 3 year, 5 year of time frame. That is very, very important. And the second is change in P multiple, which is more perception driven. In a way, if you see, the change in P multiple is slightly more trickier, because in a shorter period of time, this change in P multiple is function of how the return on equity, it is function of how the mood of the market is, right? So if mood of the market is good, your valuations are higher. If mood of the market is bad, your valuations are lower. But in a longer period of time, this change in P multiple is a function of return on equity and capital allocation. If companies which are growing at a rapid pace, and if they keep on redeploying the capital back into business, which is able to make more return on equity on that additional capital, then probably your P multiple will expand over a period of time. Now, whatever I said, if we see in numbers also, like between 2007 and 2012, this 15-year period data, companies which had delivered more than 15% CAGR return, if you analyze those companies, their profit growth rate was more than 15%. Their return on equity was at 18.05 in 2007, which became 18.5 in 2022. So high return on equity remained for almost 15-year period. And what it led to re-rating of the companies. They were trading at 20 P multiple in 2007. And their median P multiple changed to almost 40. So investors were positively impacted because of both change in profit growth rate. The change in EPS was also very strong, and the change in P multiple also played in favor of investors. On the other side, if you see the bottom two rows, companies which have delivered negative 15% or negative return over a 15-year period, if you analyze those companies, their profit was negligible. Their return on equity went from double digit to single digit, and it led to de-rating of the company. They were trading at around 20 P multiple in 2007, which became single digit P multiple in 2022. So investors were negatively impacted because of both change in profit growth rate and change in EPS bhi nahi hua, and the change in P multiple also played against the investor. The third one is very interesting. If you see companies which had delivered very reasonable profit growth rate, but they were not able to deploy the capital back, and their return on equity got declined. They were trading at 18 return on equity in 2007, which became 12.6 in 2022. And that's the reason, if you see, their P multiple was almost in that range. The P multiple did not expand it, right? So that is what we are aiming for. If you get the return on equity improvement also on your side, and along with that, if your starting valuation is reasonable, then probably you can expect some sort of re-rating happening also over a period of time. So that is how the objective of our investment team is to identify companies where the profit growth rate can remain strong, where there is a possibility of improving return on equity, and along with that, aim is to identify them at a reasonable valuation. And we believe valuation is very, very important. We'll highlight that aspect also in subsequent slides. Now, where are these kind of opportunities today, and where we believe the trends which have changed are very, very interesting. And what trends which have changed, which I am talking about, this is again very, very interesting slide of our presentation. If you see this data is of last 8-year period, starting from 2015 till end of September 2023. And what we have done, we have divided this period into two parts. First, between 2015 till end of 2019. And second, 2019 onwards. If you see the previous 5-year period between 2015 and 2019, as we were discussing in the previous few slides, the EPS growth rate of large cap, mid cap, and small cap was negligible. For large cap, this number was less than 2%. For BSE Sensex, for BSE mid cap, this number was slightly more than 2%. And for small cap, it was 0%. No profit growth rate for almost 5-year period. And there were reasons for it, and we have discussed. But in brief, The asset quality review started in 2014-15, and for next 2 years, banking profit was impacted. 16 we had demonetization, 17 we had implementation of GST, 18 we had NBFC crisis, 19 we had consumption slowdown, and these were few reasons apart from many because of which. Despite having reasonably favorable macroeconomic situation, companies were struggling and they were not able to deliver any profit growth rate. Interestingly, the change happened subsequently in the subsequent 4 year period. Like, let's say, if you take the period between December 2019 till end of September 2023, the profit or the EPS growth rate of Sensex, mid cap and small cap has actually improved in a very big way. For Sensex, this number is more than 15%. For mid cap, this number is more than 25%. And for small cap, this number is more than 45%. So profit growth rate, which was almost flat for 4-5 year period, has actually improved in last 3 year period. And again, for that also there are reasons like the trigger points which were there. And you can see this data from two lenses. If you put a layman lens and if you analyze any crisis of last 15, 20, 25 years, normally what you'll observe that after every crisis, a stronger company becomes more stronger. The weaker player, the inefficient player, the non-serious player vacate the market share. And when we are talking about a crisis like COVID, where companies were struggling and they were not able to make any sales, only the weaker players were impacted the most, and they actually vacated the market share for the larger player to grow much more faster. Another way to look this data is that there were a lot of issues between 2015 and 2019. But there were a lot of positive steps also which were taken. And again, we have spoken, but in very brief, the initiatives like RERA, GST, Insolvency Bankruptcy Code, Corporate Tax Cut, PLI, last 3 year budget, which was more focused on spending. The spending is happening behind infrastructure, railways, metros, defense. And one global phenomena also which is playing out in favor of manufacturing sectors outside China, which is China plus one business strategy. All of that explains this improving earning growth rate. Now, aim is to identify companies where this can sustain. And along with that, if we can buy those companies at a reasonable valuation, we believe we can build some sort of margin of safety also into the portfolio. So that is what we are aiming for. But coming back to this data again, this data, if you see, is of indices. Large cap, mid cap, small cap, index ka data hai. To understand from where the delta is coming in this earning growth rate, which sectors are contributing, which segment of the market is contributing, what we did, we divided the markets into two parts, B2C companies and non-B2C companies. B2C companies which were more near to the consumer. If you see between 2004 and 2009, their profits were growing at 14% CAGR. So again, companies which were catering to large population, companies which were catering to young population, they were doing very well between 2014 and 2019. Their profits were growing at 14% CAGR. But the non-B2C part of the market, and large part of that is manufacturing, was struggling, and the profit growth rate number for that part was only 3%. Again, there were various reasons for it, but one of the major reasons was how China was dumping deflation across the globe. And we used to import from, let's say, safety pin to boiler, turbine to tube, lot many things from China. And not only us, but across the globe, trends were same. That's where the change happened after 2018 and 2019. When there was conflict between US and China, and COVID, which happened in 2020, a lot of large corporates and developed world is now willing to diversify their supply chain. And that's the reason, if you see post 2019, nothing major has changed from consumption point of view. And that's the reason B2C companies continue to deliver 14% CAGR profit growth rate. While the non-B2C part of the market, which was growing only at 3%, that part of the market is growing at 26%. So the point is, in a previous 5 year period, only one part of the market was doing very well, which was B2C. But in last few years, specifically post 2019, both part of the market, B2C and non-B2C, are doing well. And that's the reason at an aggregate level, your profit growth rates have actually improved. Now, while this is interesting data point, but the next slide is even more interesting. If you see, the non-B2C part of the market has the profit growth of that part is 26%, but market cap growth of that part in the same period was around 20%. So the profit growth rate has actually grown much more faster compared to market cap growth rate. And that's the reason in that bucket, we are finding a lot of ideas where the PAT growth is very strong, but valuations are reasonable. We like that part of the market. And that's the reason in lot many of our strategies, we have a good amount of allocation into manufacturing bucket. But again, it is not a manufacturing portfolio. Today, we like that part of the market, and that's the reason we have higher allocation on that side. But it's a flexible mandates. We believe to have flexibility is very important in any strategy or any fund or any portfolio which we are managing, because the dynamics can change much more faster than what we are expecting, and that's the reason we have kept every of our strategy which we are trying to take it to our investors more flexible. So today we like non-B2C part of the market, and we are positive on allied sectors also. Like in manufacturing, there are sectors like defense, textile, auto ancillary companies, chemical companies, metal companies, electronic manufacturing. Many companies are there in manufacturing space which are beneficiary of that. Then there are allied sectors like banking, logistics, industrial products, power. All that is again very they are also positively impacted because of manufacturing related activities picking up. So that is how we are seeing markets. Another aspect is, now whatever we saw in the previous few slides again was more from a index level point of view, but even if you see from sector to sector point of view also, there are sectors which were not doing so well between 2015 and 2019, but their profits contribution has actually improved in a very big way. Like let's say if we take example of bank, which had delivered a negative profit growth rate in the previous 4-year period, 4.5-year period, but in last 3-year period the profit growth rates have actually improved. Second is infrastructure, third is IT, fourth is commodities, fifth is metal. So there are a lot many companies which had contributed to this profit growth rate, and it's widespread phenomena which is playing out at this point in time. The another aspect which is also playing out in the consolidation of the market, right? You can see we have highlighted only few examples, but the banks, the top 6 banks credit market share is much higher today compared to FY 2017. Cement, steel, telecom, aviation, in lot many sectors we are seeing consolidation happening. And in the smaller sectors where the unorganized segment was much more larger, that's where the consolidation is happening even more rapid space, specifically after 2020. So in case of unorganized to organized shift, we were seeing that shift happening gradually post implementation of GST in 2017. But post COVID, the shift is happening much more faster, because the organized players which had access to capital markets, they were able to survive that tough time, and that's the reason they were able to capture that market share. In subsequent time, we'll see the competition coming back once the situation normalizes. But the point is, if companies have that moat, companies have that strong cost advantage, they can continue to remain very strong. So how we identify these kind of companies, and that's where the investment framework is very important. So it's based on 3 parameters: business, management, and valuation. Our aim is to identify companies which are growing faster than the sector, and sector which is growing faster than the overall GDP. And we believe companies have to have some sort of moat which can ensure that growth is not only for 1 year, 2 year, but it can sustain for longer period of time. Once we like the business, the second parameter is management, and corporate governance standard is very important. But apart from that, the capital allocation is also what we are very focused on. Once we are comfortable with the management, third parameter is valuation, and valuation is third because we believe if we get a good growing company which is growing faster than the sector, and where the management is also competent enough, we cannot get that company at a cheap valuation, and we have to pay premium. And we are ready to pay premium, but we believe the premium has to be reasonable. Even for a good quality company, if you pay very high premium, there can be a scenario that you are not making return for next 3 year, 5 year, 7 year, 10 year, depending upon how much premium you have paid. So that's where we believe all 3 are very important. High growth business which is managed by competent management, and it has to be available at a reasonable valuation. To identify these kind of companies, the biggest advantage which we have is the research capabilities, and research capabilities are actually common between mutual fund and PMS and AIF, and that's the biggest advantage. I would say internally we are covering around 470 companies, which is very large universe. Even if you remove the large cap 100 names on mid and small cap sites also, we are covering more than 370 companies. So that's the advantage. This 22-member research pool is actually common for both the businesses, and this pool is actually common, but the investment team is separate. So the fund management team is separate, because we believe on PMS and EF side, where you want to make a concentrated portfolio, you want to take much higher active share, and that's where the thought process is slightly different. So that's where the role of individuals are also very important, and that's where we have got Mr. Anand Shah as the head of PMS and EIF investment. He has got more than 23 years of experience managing public money. He has seen cycles of last almost 2 decades. So we believe his expertise, along with expertise of Chokalingam and Gitika Gupta, both of them have also around 2 decades of experience of managing public money. So his expertise of this team, which is more focused on PMS and EIF, along with the research capabilities which are common, we believe it brings a lot of value addition for the investors on the table. Each and every idea which comes into the portfolio, at least 5-7 people are involved, and post debate, discussion, and due diligence, company find place into the portfolio. Point is, even after doing all this, we can go wrong, but aim is to go more right than wrong. If we go more right than wrong, if we make more money where we are going right compared to losing money where we are going wrong, that's where we believe we can create that alpha over a period of time. So that is what we are aiming for. That is what for which we are working for, and we believe over a period of time we should be able to do that. How both the portfolios, now we'll try to keep it brief so we have sufficient amount of time for Q&A, but there are 2 strategies which we wanted to discuss, and while we can discuss more in detail, but the 2 portfolios, Contra and Pipe, are very well positioned. So Contra is our diversified mandate, which can invest into large cap, mid cap, and small cap, all 3 segments of the market. Today, the portfolio is around 55% invested into large cap and 45% is invested into mid cap. The pipe strategy is more small cap and mid cap dominated. So around 90% is small cap and 10% is mid cap. So that way it's only focused on mid and small cap side of the market. The companies which we have in both the portfolios, if you see their PAT growth rate number in last 4 years had remained very strong. For Contra, the number is 38%. For Pipe, the number is 46%, compared to Index, which has delivered around 18.5% of PAT growth rate in last 4-year period. Why 4 years? Because now if I compare 3 years, then the base is to 2020, where the number can look even more stronger. And that's the reason we have taken a pre-COVID base, which was 2019. The point is, at an index level, first of all, having 18% kind of profit growth rate number is a great number to have. But the companies which the portfolio was able to identify, the profit growth rate numbers was even more stronger. Both the portfolios have seen improving earning growth rate, improving return on equity. For Contra, this number is going to 15 from 10. And for Pipe portfolio, the number is going from 12 to 18. So both of them have seen improving return on equity. And along with that, if you see the P multiple of both the portfolios, they are very, very reasonable compared to markets, where markets are trading at 22 P multiple. Contra is trading less than 15 and Pipe is trading less than 16 P multiple. So as I said, our aim is not to give you cheap value companies portfolio. Our aim is not to give you lower P multiple portfolio. Our aim is to focus more on growth. Our aim is to focus more on improving return on equity. But fortunately, at this point in time, at a portfolio level, the P multiples are also very, very reasonable. So that is how both the portfolios are positioned, where we are getting these kind of ideas. And if we see Contra portfolio, broadly, it is divided into 3 parts. The first 30% or first 1/3 is invested into financial services, which includes banks. The second 1/3 is invested into manufacturing, but very well diversified in sectors like metals, defense, textile, auto ancillary companies, chemical companies. And the last 1/3 is more diversified, where we have sectors which are allied to manufacturing, like transportation, construction, power, and around 10%, 12% of the portfolio is invested into consumption basket also. The portfolio is very well diversified in terms of market cap. So around 53% is large cap and around 47% is invested into mid cap. So that way it's having a balanced bifurcation within the market caps also. While this portfolio looks like this today, it has not remained same. It will change over a period of time. Like let's say if we take example of banking sector, which is around 25% of the portfolio today. But if you go back and check our portfolios in 2019, we used to own very less banks and weight into pharmaceutical and IT used to be much more. Both the calls, overweight pharma, underweight banks, played out well for us in 2020. And gradually we had reduced our allocation into pharmaceutical in 2020 and increased our allocation to sectors which are more economy related, which played out well for us in 2021 and 2022. By end of 2021, we reduced our exposure gradually and we became zero in IT sector. Again, that call played out well for us in last 15-18 months when IT as a sector underperformed. So all that kind of sector rotation we keep on doing, and that's where you will find difference between retail products and PMS products, where you are taking that active share, you are going that much away from the benchmark. The point is, if you go away from the benchmark, you will have more volatility in the portfolio. But if you go more right than wrong, that's where the alpha will get created over a period of time. So that is where the role of investment team, the role of that research team, which we spoke about, is very, very important. And that's where the size at which ICICI Prudential AMC operates becomes an advantage for us also. So while Contra is positioned like this, pipe portfolio, if you see, is a small cap and mid cap strategy. So around 90% is small cap and 10% or so is into mid caps. Again, very, very well diversified portfolios in terms of sector bifurcation. And we believe someone who wants to take that mid and small cap allocation, for those kind of investors, pipe also is very well positioned, because again, you had a very strong profit growth rate, improving return on equity, and a reasonable valuation in this portfolio also. How these portfolios have performed in last few years? Last 1 year portfolio, Contra portfolio was up 33%. Pipe was up 44%. The 3-year and 5-year returns are also very strong for Contra portfolio. And we have completed 4 years in Pipe portfolio. Again, since inception, return is around 32%. So that's where Contra and Pipe have how they have done in last few years. While we believe this data can give you comfort that how we have done in last few years, but for someone who is planning to invest today, this data point is of no use. It can just give you comfort that how the portfolios have done in short period of time and long period of time. For someone who is planning to invest today, we believe this data point or how the portfolio is allocated today is more important. The companies which we have in the portfolio had a very strong profit growth rate, improving return on equity, and a very, very reasonable valuation. So what I'll do, I'll take a pause here and we can make it more interactive. Any questions, any queries, if you have, we'll be very happy to answer those. Thanks a lot. Thank you.
Thank you so much, Sandeep, for such an insightful session. I think the numbers that you showed on both the economy side and the sectoral side have been very insightful. I think we had one question in the chat about the PE of Contra and Pipe. I think it's clearly shown over here. The Contra PE is 14.77 and Pipe is 15.74. Just a few questions from me, and then I'll take the questions from the audience. And I particularly like the slide where you showed the difference between volatility and a risk. And a lot of people don't understand the difference between the two. And what I believe is volatility is the function of emotions that come into play into the market. But when we are seeing the current volatility in the market with a lot of inflows that are coming from the domestic players in terms of SIP book is close to 16,000 crores. Balance advantage category is very huge in the market. So earlier when FIIs used to pull out money, markets used to correct. And we have seen there were 10 times when markets corrected by more than 30%. But do you believe that with the domestic flows becoming very strong, the inherent volatility in the market is reducing?
So I would say it is giving a lot of support to markets. Like in 2022, if you remember, every month foreign investors were pulling out of the market, but markets were very resilient because of the domestic investor showing that confidence. So it definitely helps. The another aspect which you spoke about in last cycle, like between 2003 and 2007, lot of sector oriented funds got that huge inflows. But the good part is that mutual fund industry in last 10 years, the category which has grown at a very rapid pace was balance advantage category, and ICICI Prudential AMC was the first one to launch that kind of proposition. The point is that category also brings lot of cushion to the markets, because that works in a counter cyclical way. Most of the funds in that category work in a counter cyclical way. So when markets are falling, those one will increase the equity allocation, and that's where the support will also come. So all this is obviously very very useful, and that is giving the strength to the market. And hopefully we will see. I would say. It's not correct to say that we'll not see drawdowns, but it is very very useful that we have got a very large SIP book, and we have got a very large balance advantage fund category into the markets, which will help to reduce the drawdowns in times to come.
Surely.
But I would say it would be, we should expect that market will give you those kind of volatile phases, because it's also useful for you to make better investment decisions.
Right. Absolutely. Absolutely. The next question we have from Mr. Apurva. What is your view on the interest rates? And particularly from my side, we have seen the US interest rates going above 5%.
Right.
And what are the implications on the interest rate side and the risk that we are facing on the domestic markets?
Right. So obviously, your higher inflationary environment or higher interest rate environment will be negative from valuation point of view, right? Because your cash flows will get discounted at a higher interest rates, and that's where your valuations will take a knock. So that is what is expected. Obviously, higher interest rate scenarios will be negative for equity market if they remain high for a longer period of time. But it also gives you an idea that the economy is doing reasonably well, and that's the reason the central banks are able to take that interest rates on the higher side. So in a way, it is in a way, from economy point of view, it's a signal that your economy is doing well, and the companies which will be beneficiary of the economic growth rate, they'll actually grow at a higher profit. So profit growth rate can actually improve for those set of companies. But from valuation point of view, obviously it's negative. So that is how we have to see. The only thing is that these phenomena were there in last 20 years also. We saw global financial crisis in 2008. We saw various volatile phases of currency also in 2013, 2015, 2018. We saw that also in last 20 years. So as I said, these phases will keep on coming, and only thing is that you have to have a longer time horizon on your side. And we can take that advantage of volatility. So we can deploy gradually and take advantage of that. But from answering your question point of view, which it's worrisome situation from a valuation point of view for equity markets.
Right. The next question we have is, which are the 2-3 sectors where you can see clear tailwinds in the next 3 years' time, 3 to 4 years' time?
So banking is one of them, definitely, because in terms of valuation also, if you see, they are reasonably placed at this point in time, and that's the reason we have good amount of allocation into banking. Then there are various different sectors like auto ancillary. There are sectors like manufacturing as a theme, if you see, is very well positioned at this point in time. So that way we are seeing. But from a portfolio point of view, and when we talk about PMS point of view, it's more bottom-up approach, I would say, which matter more for us. And if I give you an example, if you see transportation sector, now the weight looks 7%, but the companies which we have in the portfolio out of that transportation sector, one is VRL Logistic and the second is G Shipping. Both of them have completely different dynamics. So that way it's more bottom-up rather than a top-down view which we have on alternate side.
Right. Next question is from our YouTube feed. You are part of the investment team in the PMS and AIF alternate category. What are the key differences between a PMS or a mutual fund, uh, provided that your investment team remains the same, your analyst team remains the same, but what are the key differences that differentiates a PMS from a mutual fund,
Right.
apart from the minimum ticket size?
Right. So if you see from a structure point of view, obviously mutual fund is a pool-based structure where the money is managed for all the investor in a similar way. And on a PMS and AF side, specifically on PMS side, it's a differentiated portfolios. Like your portfolio or Demat account would be different, and my Demat account, if I'm coming into PMS, would be different. While the portfolio might not look completely different, but at a starting point, they might look different. So that's where the difference comes. Let's say if you came around 15, 18 months back, your portfolio in Contra might look different compared to I investing today. There will be few new companies which will come into my portfolio. So that way, individual portfolios may be different in PMS strategy, which is not the case in a mutual fund structure where uh, you have the entire corpus getting invested in a pool form. The second is obviously in mutual fund you have retail investor also who are giving you 500 rupee SIP investment also, and there are investor who would have given you 50 lakh, 5 crore, 50 crore, 500 crore also into same fund. So that's where the objective of investment objective is very very key. What kind of objective with which the mutual fund schemes are operating. But in case of PMS, obviously the minimum ticket size is 50 lakh rupees, and that's where the portfolios are also different, and that's where the thought process with the investment team operate is that their active share which investor is looking for is on the higher side, right? So they want high active share portfolio. To give you an example, let's say if you see this portfolio, Contra portfolio, there is no IT, no pharma at this point in time, which typically you'll not see in a diversified equity mutual fund scheme. So that's where the difference comes into picture. Now, this is what I said from positive point of view. The negative point of view, as we were discussing in earlier conversation, also the more you go away from the benchmark, your portfolios will have more volatility. Like being being zero in IT and pharma can give you that period of underperformance also, and that's where the portfolios will have more volatility compared to mutual fund, which will be more diversified, more balanced, and which can give you better return experience, decent return experience at the end of the tenure of 3 or 5 years. So depending upon what you want, depending upon what you are looking for, both the strategies, mutual fund and PMS, makes a lot of sense. It's actually not a case where we are discussing mutual fund versus PMS, mutual fund or PMS. Actually, it's mutual fund and PMS.
And
So
PMS.
part of the portfolio would require stability, part of the portfolio will require lower volatility, and part of the portfolio you'll want that aggression coming into picture. And that's where the role of PMS or actively managed strategies will come into picture. And that's where the role of PMS or AF comes into picture at an investor's portfolio level.
Right, right. And we also, as wealth managers, we get a question about how does index and active management play out versus each other. And you manage five, which is a mid and small cap focused category. So how does active management play a role while managing a fund in mid and small cap space?
So actually, in mid and small cap, the active management is even more required compared to large cap. Obviously, in large cap also there are enough and more opportunities. We have one large cap
Right.
PMS which has done extremely well compared to the markets in last 1 year, 2 year, 3 year period. So in large cap also active management has played a very very important role. But in mid and small cap, the role becomes even more important because you have to identify companies which have not only good business, but a quality of management has to be also up to the mark, and valuation also has to be reasonable. So in case of mid and small cap, where you have lot many companies available, you have to filter out companies where either you are not comfortable with business, management, or valuation, and then the remaining companies is where you will try to put more selection framework. So that's where the role of active fund manager or active investment strategy becomes very very important in mid and small cap, because if you see beyond top 100 companies which are considered large cap in terms of market cap, you have lot many companies which are there. BSE small cap index has got more than 700 companies, if I'm not wrong, around that company. So the point is, in small cap index you have those many companies to select from, and that's where from 700 companies you are filtering down to 25 to 30 companies, and that's where you have to have lot many parameters to look at. And that's the reason the alpha is also much more stronger. Like if you see, while the comparison is versus BSE 500, but you can see alpha which small cap PMS can deliver if everything goes well, if you stay invested into the portfolio for a longer period of time, can be much higher. Obviously mid and small cap will have more volatility also. The drawdowns can also be sharp. But if you remain invested for a longer period of time, obviously the active selection can play out a very important role.
Absolutely, absolutely. And the next question we have from Mr. Naren Karnam. So minimum ticket size in PMS is 50 lakhs. Is there a particular lock-in in these two PMS? And how does it work if they have a specific Demat account? But how does it work if they are already holding a Demat account? We open a new Demat account. So just for the benefit of the audience, if you can just highlight the same.
So there is a separate Demat account which is required when you invest into a PMS strategy, because to manage that Demat account, the agreements are done so that it can be managed by the fund manager at ICICI Prudential AMC. But once you redeem, once you get out of this fund, along with that, the Demat account also get closed. So that way, it's a very, very simple process. Once you enter, the Demat account is open. Once you exit from the fund, the Demat account is closed along with that. There is no hard locking in the strategies. There is exit load of 1% for 1 year. Post 1 year, there is no exit load also in both the strategies.
You can also transfer a part of shares from one's Demat account.
Yeah, so that's possible. Right. So partial transfer, combination of stock transfer and check can also be done in this strategies.
Right. Thank you so much. We'll just take up a last question. So we always recommend going long term for equity investments. So what is the horizon that you look for both the PMS strategies that you run?
So ideally, you should have around 5 year of investment horizon when you are investing into any equity oriented product, and specifically when you are investing into PMSs which are trying to take that concentrated approach. I think 5 to 6 year kind of period should be a decent period, specifically for both these strategies.
Right. Thank you so much, Sandeep, for this session. It was such an insightful session on the macro side, on the micro side, and as well on the operational side, on the how PMS works, how it differentiates from a mutual fund. Thank you so much for joining in on Saturday and addressing the audience. And we look to do more such sessions with you and your team in the future.
Sure. Thanks a lot. Thank you. Thanks for the opportunity, and thank you everyone for joining the call. Thanks, Aditya.
Thank you everyone. Thank you.